it is clear to us that the coronavirus will deliver a significant negative shock to the global economy. As we saw last year, the global economy was already slowing before this economic shock hit, and growth was already uncomfortably weak. Initially, we had hoped that the virus would remain contained within China and Asia, but clearly that is no longer the case. We have seen a sharp increase in the number of cases outside of Asia, and that further increases downside risks to global growth. We now think global growth will slow even more sharply going forward, and the risk of a global recession in 2020 is becoming increasingly realistic. Going forward, we expect to see more supply chain disruption and also more evidence of a hit to global demand. And even in the best case scenario now, we think this disruption to the global economy will persist at least through the first half of this year. Well, we have already seen global policymakers start to react to the downside risks from the coronavirus. The Fed was very much leading the way and delivered an emergency 50 basis point rate cut, and at the same time clearly signaled that they've left the door wide open for further easing going forward. Similarly, we now expect the Bank of England and the ECB to respond as well. But on that side, we would stress that the room for manoeuvre for the ECB and the Bank of England is a lot more limited than the Fed. So we think it's more likely that they will take a more targeted approach to provide support to the economy, looking to improve or lending conditions for companies which will be hit harder by the coronavirus disruption. Closer to home in Europe, we expect national governments to step up to the plate and provide more fiscal support for growth. The EU, we expect, will allow governments to deviate more from their fiscal rule. And over in Italy, we have already seen the national government there put in place emergency measures to support growth, totaling up to 3.6 billion euros. And here in the UK next week, when the budget is released on the 11th of March, we also expect the new Chancellor to announce a range of measures to provide more support for growth, particularly to those companies which will be hit hardest by the coronavirus. The intensification of global growth concerns have already weighed very heavily on high-yielding emerging market currencies and also commodity-related currencies. On the other hand, the low-yielding currencies of the euro, Swiss franc and yen have been outperforming, and we expect that trend to continue going forward. That has been driven both by the liquidation of funding positions, and increasingly we feel there will be a pickup as well in safe haven demand for those currencies. The dollar, we feel, should hold up relatively well more broadly, even if the Fed is cutting rates aggressively, given concerns are likely to remain very elevated over the outlook for global growth.